Hello. Well, certainly very interesting times in markets once again. I think we're in a very strange place with capital markets right now. We know that the ECB now has completely got the green light to going out to enacting quantitative easing on January 22nd. Will they do that? Well, I personally believe they should. I believe there's no point in waiting around. Mr. Nowotny from the ECB talked about giving clarity, giving certainty to the market sooner rather than later, and therefore I believe we will hear some pretty definitive news on January 22nd. Last night, the European Court of Justice, the Advocate General, gave the green light and said that it was constitutional for the outright monetary transaction policy, which was enacted originally or floated by Mario Draghi back in 2012, to actually come to market. Now, the importance of that, it suggests that if the ECB were to buy bonds in the secondary market using base money or expanded base money to go and buy these bonds, there is absolutely nothing that's unconstitutional about that. It is considered an unconventional monetary policy tool. That's the interesting situation, that the Germans were considering as a fiscal policy tool, and therefore it being unconstitutional, and actually debt forgiveness could potentially come if there was going to be a write-off further down the line. The importance of this situation, and from what we've heard from the Advocate General, is that the ECB have actually no conditionality to this whatsoever. They can be pari passu to other investors at the moment, which means they don't need to be more senior. If there is a debt write-off, if there is a forgiveness coming through, they will be treated as other investors as well. Now, that's an important step that's coming through. Now, if you look at the moves in the bond market, which I think obviously we always will in this situation, you've got the German 10-year yield trading at 42 basis points. That was down about 5 basis points last night, another record low. We keep saying that every day. The interesting point here is that now the so the German Treasury can actually go out and actually raise money at 42 basis points for 10 years, which is absolutely crazy. If you look at Spain and Italy, record lows coming through. Their 10-year dropped 5 basis points. If you look across the spectrum in Europe, you've got about 10 central banks now, if you include the Swiss central bank, which are trading with a negative number. They can actually fund themselves at a negative number. You have to pay their central bank, or you pay their treasury, to hold cash for them for 2 years, which is absolutely nuts. Now, if you look at what's happened further out the curve, 5 years, we've got negative numbers in at least 3 central banks. Switzerland, if you look in their 10-year at the moment, I know they're not to do with quantitative easing, but of course their central bank has enacted this in such a way that their 10-year is now trading at 15 basis points. The big question mark in the market is whose 10-year yield or 10-year bond yield will actually fall to below 10 basis points, have a single-digit number on that as well. So that's going to be an interesting situation to watch over the coming weeks. But we now know that quantitative easing can be enacted on January 22nd, and Mario Draghi should do that to give us clarity. The question is, will it work? My personal belief is it won't. €500 billion of quantitative easing and some private bond buying as well will not do a single thing in terms of driving inflation. Banks will hoard the cash. In fact, basically the money that's coming back into the banking system is replacing the money that's been paid back from the first 2 total targeted long-term refinancing operations. We need to see a huge amount more coming through, and I think that will be the case. I think there will be a much larger degree of quantitative easing from Europe further down the line, similar to what we saw from the Bank of England, where they started small, about 5% of GDP, and they built that up over time. I think that's exactly what we're going to be seeing in Europe coming through. But certainly the bond market has reacted in Europe. The euros, if you look at it on a daily chart, seeing big indecision. There's a doji there, and we can see we're just not quite sure where the next path is. My best guess is that the euro dollar goes considerably lower over the next couple of years, driven by that balance sheet expansion, driven by the stronger dollar. If you look at retail sales last night, a little bit disappointing. Here in Asia, we're looking for a weaker open. We've got the market opening about 20 basis points. Everything's going to be about energy today. We've seen a massive move up in the price of WTI, price of Brent prices from 4 o'clock yesterday, based on very oversold conditions, based on the fact that we've had a big bounce off the 1998 trend line if you look at WTI on the daily chart. So that's very positive, I suppose, for oil prices, and we should see some good short covering in energy stocks. The question you've got to ask yourself, is this now the start of a longer term trend? Is this an investable sector, or is this a dead cat bounce? My best belief is this is a dead cat bounce. I would be waiting for this to play out a little bit longer, and then I'd be looking at fresh shorting opportunities, because I still think the fundamentals suggest that the oil price could go below that $45 mark on both Brent and WTI going forward. Copper price as well was the big talking point on the markets yesterday. If you look at where they were in relation to the 4 o'clock close here in the ASX 200, up 1.6%. We should see some short covering coming through in the copper stocks as well, albeit people being slightly cautious in that space. The big talking point today will be what's happening on the unemployment numbers here in Australia. The Aussie dollar looks fairly well supported. We've got a 19% chance of a rate cut coming through in February. It's not going to happen in my mind. We've got 41 basis points being priced in the curve over 12 months. Seems about fair in my mind based on my fundamental judgment of the Australian economy. If you look at swap rates here in Australia against US, they have been blowing out in favour of Australia. That's supportive of the Australian dollar over the US dollar. So I think we're going to start seeing the Australian dollar really basing around here, looking to consolidate, perhaps move sideways. If we can get a break of that 82 handle, perhaps it can go into my long-term sort of short limit, which I really would like to start selling the Aussie dollar against the greenback around the 83.20 level, which is the 38% retracement of the recent pullback that we've been seeing. But certainly the unemployment numbers today will be mostly the big catalyst there. The market's looking for 5,000 jobs. If we get anything above that level on a net basis with a good quality numbers, a high participation rate, a lower unemployment rate, potentially, I don't expect to see that. I expect to see it at 6.3%, but a nice genetic makeup of stronger full-time jobs, less part-time jobs as a ratio of those full-time jobs, but a good number today, and we may see a pop in the Aussie dollar. But remember, personally for me, longer term, the Aussie dollar remains a good longer term short here.